on Facebook for the Tuesday edition of the Not Your Average Investor Show. I'm breaking stuff all over the place because I'm so jacked up. Welcome, everybody. My name is Pablo Gonzalez. I am the host of this program. And with me, my co-host, the man that they call GC, because he just gives clarity on important topics like today, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Pablo, another incredible introduction. This time I saw your hair move as you were doing your introduction, which is incredible. Good to be with you, everybody. We love to have a lot of fun, and you all make it a lot of fun. So thank you for indulging Pablo and I. You know what? Pablo and I work really well together, and every week, you know, he challenges me and I challenge him on very specific things. And one of the things I challenge him on is how to do it bigger and better for his introduction every single week. And you never cease to amaze, brother.
You know, it's funny, man. I normally am entering this with an empty stomach, but since I have I'm gonna go on a podcast like right after the show today. So I just ate, and now I'm like, man, I don't know if I should have got so big. But anyways, that's neither here nor there. I'm here for you people. So you know, this show, as you know, anybody that's coming back, you know that this is an interactive show. We want you chiming in. 2 ways to chime in. Number one is the chat, and as you see, it's lighting up. There is also a little trick to the chat in that when you first join in, it is defaulting to only speaking to us panelists. So that little blue box that says panelists, I need you to drop that down and make it panelists and attendees. Eddie Harris, I'm talking to you. You're only speaking to us right now, but I welcome your comment. He says, Gregg, you crushed it yesterday on your presentation at Virtual Ignite. And Eddie is from Atlanta, one of my favorite places to call out.
Thank you, Eddie.
And the other way to interact with us is get your question answered by Gregg today, right? I'm sure you have questions about coronavirus. That's what we're talking about today, COVID-19 and the effect of the economy and what's going to happen going forward. So if you want me to ask Gregg that question, please pop open that Q&A box that's on the bottom right and put it in there. The reason why I ask is because it saves it there and it keeps it in front of my face. You're going to see that the chat, we got this awesome community and people like to make friends here and talk and give your own comments. And we want that to happen, but that makes it move really fast. And then it makes my eyes cross-eyed when I'm trying to like keep track of your questions. And I really, really want to serve. So just help me help you and put it in the question and answer there. And last but not least, if this is your first time joining us and you want more of like a initial breakdown of rental income and rental property investing and, you know, the 3 things that you just got to get right before you get into this asset class, go to jwbwebclass.com. It's a 20-minute webinar by Gregg that's really, really informative, and you get to download the free investor toolkit with the property breakdown that we use every single week. Super valuable. And last but not least, if you want to have a customized plan built for you, you're ready to take the next step, you just want to talk to a live person that's going to give you some personalized advice, go to chatwithjwb.com. Easiest place to just pick a time, hop on the team with Courtney and the mics, and you're going to have almost as good a time as you do on the Not Your Average Investor Show.
It's a high standard that we put here together at Pablo. You know what? The only thing I think is different is Courtney may not come forward with the hair moving introduction like you do.
Well, you know, I don't expect that from Courtney. That being said, I'm already seeing some great questions coming in on the chat, and because we haven't gotten into it yet, I'm just going to repeat it. Please, Raja, Chad, I want to answer your questions. Please put that in the Q&A section because, you know, we're going to kind of like give a little overview first, and then I want to get straight into what you're talking about. So if you put it in that Q&A section, then I get to really, you know, keep track of it and build it in as so it makes sense for everybody. Chad already doing it. I appreciate you, my friend. Also, Chad, if you want to talk to everybody else, you're only talking to panelists, right? Drop that blue button down and go to panelists and attendees. Christine Taylor is asking only us because you guys have to change that. Christine, is anybody getting an echo? Let us know in the chat if there's some kind of weird echo happening. It sounds okay to me. There's a little bit of echo in Gregg's office because, you know, room echoes, but I don't think it's disruptive. So let us know if anything is happening. Gregg, that being said, let's get into this, man. I wanna, you know, we want to provide as much value, as much clarity to everybody here. And I kind of want to start with, this is our second time going into, you know, COVID seems to be coming back into the economy here. There is likely going to be a new uptick, you know, according to the data and the news or whatever. The first time that we had headed into like this uncertain period, you came pretty strong with some opinions that you were nervous about saying at the time, but you put them out there. And that was that this wasn't going to drop housing prices. You also said that, rent collection will be TBD, but you don't expect a giant effect on your portfolio. And three, you also said that rental property investing is actually built for times like this. So let's start there. Why, at the end of the day, spoiler alert, everything you said has come true so far. What were you basing those statements on when you first said them, when we had no data on COVID?
Well, there was really no game plan or rule book to follow for a pandemic out there across any asset class. But that didn't mean that there wasn't data points that you could look at and understand how it would affect things like home pricing. Or it didn't mean that you couldn't use your experience, which I had, of investing in rental properties during a time when we really did see the Great Recession and we saw the greatest drop in housing prices. And so, when I started to think about how to prepare clients and our potential clients and investors in Jacksonville appropriately, I relied on what I lived, what happened to my own dollars that were invested in rental properties after I purchased those in 2006 and have held on to them ever since. And then I also looked at the data. And that gave us it's funny, GC gives clarity, right? It gave me a lot of clarity, really, in a time when there really wasn't much clarity. And it's not surprising to me that the data, if you know what to look at and you follow the data and you've been doing it for well over a decade like I have, then you're not so fearful. You're able to make more calculated decisions and ultimately able to make the best decisions to produce the best returns on investment in an unstable time.
Okay. So that being said, the data has been what?
Well, so let's first talk about, for me as an investor, probably you know this, and especially in comparison to my business partners, I'm the most conservative guy out there. Right.
Yeah.
And for those who have been a part of the show, you got to interview my business partners, right? One of my business partners, when he was asked, what's Gregg's superpower? What did he call me, Pablo? Do you remember?
A turtle?
He called me like a turtle, right? Which is great, right? I'm very conservative by nature. So when we're thinking about what's the effect of COVID on rental properties as an asset class, I think about worst case scenario. And to me, if I'm comfortable with investing, even in the worst case scenario, then that gives me a lot of peace of mind to go ahead and make the best decision possible. So that's where I started out when thinking about how I was going to prepare all of you is, all right, let's go back to the real worst case scenario that I can imagine, right? If you are putting your money, if you're buying, let's say 40 rental properties in 2006 at the height of the market, like I did, and then in 2007, 8, 9, 10, 11, see the market drop 35%, how did that really shake out for my return on investment? And so that was the first data point for me. I looked at it. And what many people don't know is that when the market did fall in the Great Recession, rents stayed consistent. Vacancy stayed low for my portfolio. And it's because the job base in Jacksonville was still strong. Now, people were certainly hurting, but one of the things that's most resilient in a time where there is a huge nationwide economic disaster is housing, right? People continue to pay for housing as long as they can. And so what happened when I was investing in during the Great Recession with those 40 rental properties that I owned, that I used financing on, right? That I borrowed a lot of money to purchase those properties. And, I was 23 at that time. I didn't have a lot of money as well, right? Those were, I was not set up for success other than the fact that those properties produce positive cash flow every single month for me. And those properties continued to stay rented, continued to perform. And then the other thing about it that helped me is that I had a very long-term outlook, right? I knew that even if the market value of those properties went up 10% or 20% over the next 3, 5, 10 years, that I wasn't going to sell those properties. They were a part of my long-term hold. And I wanted to hold on to those properties for a full market cycle. And so knowing how real estate cycles work, if you're an investor and you produce positive cash flow and you invest for a full market cycle, what's going to happen is your assets are going to grow. That short-term recession that we experienced did not define my growth of those rental properties for the full market cycle. And so what's happened with those properties, I still own them today and many others. They continue to produce positive cash flow. The positive cash flow has grown since then because my rental rates have increased. And guess what? Over the last 20 years, which is a full market cycle in Jacksonville, the average appreciation rate in Jacksonville each year is 4.3%. That is the exact same appreciation rate for the long-term historical appreciation rate of Jacksonville if you go back to 1991. And this is really critical. And this is why I came so strong and I recommended others, if you're considering buying rental properties, you should still buy rental properties. It's because if you hold on for a full market cycle, appreciation rates come back to the norm and your properties are going to grow. So that's what gave me the confidence to come strong with all of you and say, listen, if rental properties were a good decision 6 months ago or 3 months ago before COVID broke, they're still a great decision, especially compared to your other choices of where you're going to spend your money and invest your money during a COVID time.
That's right. We did talk about the other places, and maybe at the end of this call we'll compare other asset classes, right? I just put on, for our friend that is listening in the future on the podcast, I just put on a slide here that shows how home appreciation rate has held solid here for 4.3% throughout the great crash of 2008 through now. It's been a constant line trend that happens throughout the market cycle, as you say. But let's talk about now then the actual affected home prices in Jacksonville. All you said was they're not going to drop.
Yeah. So if we're going kind of big picture macro into maybe a little bit more like specific to COVID times, like big picture to me, COVID did not change my strategy because I'm a buy and hold investor. I believed, because the data told me, that even if the market dropped, which I didn't think it was going to, even if it did, investors were still protected because you're investing in an asset class like rental properties, which have shown to be consistent and have shown to grow over full market cycles, just like they have historically. So that took the long-term concern of investing in rental properties off the table for me, and that's what I shared with clients. That's why JWB continued to buy and buy and buy all throughout COVID, while others didn't, right? That was a part of our strategy. We put our money where our mouth is. So now we're kind of taking the leap then, why did I say that prices were not going to drop when there were a lot of news articles, there were a lot of talking heads out there saying that that real estate was going to crash? Well, I didn't, because I didn't say that. I said it was not going to drop because I looked at where we were in terms of a supply and demand perspective in Jacksonville. And what I knew is that for a long, long time, we simply have not been building enough inventory to match household formations. Another term for household formations is demand, right? You've got households that are being created. People need a place to live and they want to buy a house. That's demand. And we had been underbuilding for a long time. Actually, since the Great Recession, we were underbuilding. We were creating basically about half the housing units that we needed all through the 2010s versus what we really needed as far as household formations. So this supply problem for us was not going away. Supply has been really, really low. And what I looked at and I said, well, if I know that supply is low, let's just say that I don't have a handle on demand at that point, because I really didn't. I didn't know what was going to happen for demand in a COVID economy, right? There were so many variables. But what I looked at is I said, even if demand was cut in half, right, which is a big jump, even if it was cut in half, the leading indicators of months of supply would not have indicated a drop in prices at that point. So that's simply what I did. I kind of ran the numbers based on what has historically been a leading indicator, which is the months of inventory, shows the supply that you have as measured by the demand that you have, and equates to the amounts of months that it would take to exhaust the inventory. And then I just started running some scenarios and said, if it dropped by half, if demand dropped in half, would we still be okay? Would prices drop? I didn't think so, right? And so now fast forward, what have housing prices done, Pablo?
Well, I have a slide up here on the screen that says that from February 2020 to October 2020, the last 9 months, home prices have risen 17.4%. And from October 2019 to October 2020, so the last year, they've risen 11.7%. So they've actually increased the rate of growth has increased over the COVID months, according to this data. Now, I'm going to trickle in the questions that are relevant to the part that we're on. Rick Margwin asks, are those median home prices that we are putting on here?
Yes, everything that we reflect is the median home sales price.
Great. There's another question here. It's by an anonymous attendee. I would love to get some clarification on this, but they type in, there's a townhome on current inventory that was bought in 2005 for 140K and was bought again in August 2020 for 106K, and now in your inventory for 140K. No appreciation in 15 years, not quite matching up to the slide. I don't know what that means in inventory. Like, what inventory is it in JWB inventory? Is it on inventory in the market? Would love some clarification. But Greg, if you have any insight to answer that.
Hard to know specifically what they're talking about, but what I can assure you is that the prices of townhomes have gone up. If you're looking at the public record and you're looking at what the purchase price was, sometimes it's just not really accurate, especially for townhomes as well, because sometimes parcels of land are cut up, right, and to become smaller units of land that you can build houses on. But I can assure you that home values for townhomes have gone up over the years. And but for something specific like that, I would just reach out to my team. And if you're a current client, reach out to your portfolio manager. We'll get you all that information that you need there. But what we are seeing is that prices have risen in Jacksonville. And the chart that we had there, just to kind of clarify a couple of things, when COVID broke in February is where I took the data, home prices were at about $236,000 for a median home price in Jacksonville. And you've seen this rise much faster than I expected, right? I said that prices were not going to drop. That's what I felt really confident in. I don't know anybody who thought that prices were going to rise to a 12% level on an annualized basis, right? And that 17.4% return from February to October, or that 17.4% increase is annualized, right? That's only 9 months of data. So that's how we get 17.4. But nobody was coming strong with that. Pablo, if you had to guess what the biggest change was that affected pricing in Jacksonville that accounted for this double-digit rise in prices, do you think it was more supply or do you think it was more demand?
I would guess that it would be, I don't think that supply can change on a whim, but demand can, right? So like you can't all of a sudden build 1,000 homes, but all of a sudden 1,000 people can be looking for properties in Jacksonville because the Northeast is way worse off in COVID than we are. Mm-hmm. Or at least,
You're right. It was a little bit of a trick question I was giving you, but you're right? So it was both, but the thing that can't be solved quickly is what you said, right? You can't have I'm not going to say you never can, but the chances of you dropping twice as much inventory on the market is really non-existent, right? That would come from builders needing to build, and that just doesn't happen in the short run, right? If you think about what's been happening with this undersupply that we've had since the Great Recession, I'm not the only person who knows this. All of these builders out there know this as well, but you have to ask yourself the question, why wouldn't they have built more homes, right? If supply is low and they know they can sell it, why wouldn't they have built more homes? Well, prices haven't been high enough that builders could build and make a profit for many, many years. And in many places, it's still not that way. So you had this sort of catch-22 that was keeping supply low. And if you're going to solve the supply problem, it takes a long time. Now, the reason it was a little bit of a trick question for you, Pablo, though, is because demand can greatly be increased, right? And we have seen this, and maybe we'll show this in some of the numbers here, but demand has gone up tremendously. Home sales has gone up tremendously. And if you have home sales going up tremendously, and you really can't increase supply all that much in a short time period, you can drop supply really quickly, right? Which creates even more of an area where home prices will probably go up in value. Even lower supply, higher demand means a greater increase in value. And that's why, in a simple sense, that's why you saw prices go up 12% year over year here in Jacksonville.
Got it. Christine is asking it ended up just coming into panelists. Christine, if you want everybody else to see it, you got to change that blue button to panelists and attendees. Christine Taylor asks, is 20 years the typical cycle? My response in the chat is 10 to 20 years is the cycle, right?
There you go. Historically, 10 to 20 years is known to be a market cycle. Basically, if you go and look back over 10, 15, 20 year segments, you're going to see that the appreciation rate in those chunks of time largely correlates to the historically accurate home price appreciation rate in your market.
Yeah. So you were just talking about showing the data, and I popped up the data that you have for me to play with here. So it's showing, if you're listening to on the podcast here, it's showing an inventory in June 2007 and December 2007 and June 2008, December 2008 of around 16,000 months of inventories were, 11.2, 18.1, 14.2, 15.8. And then when we switch over, and the average kind of like sales in those periods were $1,400, not $1,400, 1,400 homes, 900 homes, 1,100 homes, 1,000 homes. And then when I pop back over to October 2018, October 2019, March 2020, October 2020, it goes, the inventory is halved, right? So like for the first 3 data points, it goes from 16,000 to 8,000. And then October 2020, it's down closer to 5,000. And the amount of homes sold looks like they double, right? So like, roughly looks like they double. They go from about 1,400 to in the range of 2,400 to 3,000. And the months of inventory really start to drop as you go from March 2020 to October 2020, going from 3.8 to 3.0 in March 2020. And then now we're at 1.5.
Crazy low. 1.5 months of inventory in a marketplace. I've never seen that before. And JWB has been tracking this every month since 2014. And so to kind of put this in perspective a little bit, right? When you're thinking about where pricing is going to go in your market, now this is a simplified way to do this. This is not the only way to do it, but it's one of the key metrics we look at. We're looking at what is the months of inventory. And if it's between 6 to 7 months of inventory in your marketplace, that's known as an equilibrium marketplace. And that's where you would expect to see historically accurate home price appreciation, which the historically accurate home price appreciation rate in Jacksonville is
4.3%.
4.3%, right? If it's lower than 6, then you would expect to see higher than normal home price appreciation. If it's higher than 7 months of inventory, you would expect to see lower than normal home price appreciation. And as you started to get up to 10, 12, 15, 18 months of inventory, the greater the chance of a price decline. So these numbers are just flat out insane, right? 1.5 months of inventory is incredibly low. But what we're seeing here is exactly what you and I were just kind of kicking back and forth, right? What you've seen here is that inventory levels compared to Great Recession time were basically half for the last few years. It was basically 8,000 properties on the market compared to 16,000 properties on the market. Sold properties were hovering somewhere around 2,000 to maybe 2,800 sold properties per month over the last few years here in Jacksonville. But what you see post-COVID or during COVID, as we're in now, sales have been well over 3,000 sales a month since June. That had never been done before in the history of Jacksonville. So you're seeing this huge increase in demand that is lowering the existing supply, and builders either can't make money building the product that they want, so they're not building, or the product that they want, they can't build fast enough. And it's creating this environment where you have extremely low inventory, which is leading to low months of inventory. And then if we circle back to why did I not think that prices were going to go down, even if we didn't have this huge surge in demand, I was running the numbers and I didn't think that MOI was going to go to 7. I didn't think if it got to 7, it wasn't going to go that much higher, because I was just doing some case studies to see and playing with the demand number. And that's kind of how we got there.
Got it, Greg. So to put a button on this, we're talking about housing numbers, and next we're going to talk about rent collection, right? That's a major driver. That's the first question that we got asked, right? We just kind of wanted to set this thing up. We're talking about housing pricing. Me as an investor who is closing on a house, um, I don't want to buy something that's like a diminishing asset, right? Like that. So that's why we're bringing it up. We assume that you don't either, but also it's the idea of should I buy now or should I buy later is another part of the equation. So we're just shedding some light on that. So as you were breaking down these numbers, and I'm looking at this like 3.8 MOI, 1.5 in correlation to the number that it should, that the average is 6.7, something like that, you said. So to me, I look at this and it goes from, it's like at like half, and then it goes into like a quarter range. And then I think about the appreciation being historically 4.3%. And then the numbers that we just showed are normalized yearly to like 11%. So I see almost, I don't know if it's like a linear thing, but like if you go half to double, like it, when I'm doing the fraction in my head algebraically, it makes it like there, it makes some sense in there, right? So like the idea is home prices are going up. If it's at 1.5 right now, in the short term, we're going to see even higher than what we've been seeing for the last year. But
You know,
that's not your thing, right?
you know, I feel really confident that home prices are not going to go down in 2021.
Okay.
Right? There have never been more variables to the demand side of this equation than any time that I can remember investing. Right? So I don't think that people should take this and say, well, I'm definitely going to get 12% appreciation in Jacksonville next year or in future years. Right? This supply problem is not going to go away for a while, but you also have to buffer this with the reality that that COVID has really devastated huge parts of the economy. And I'm sure we'll talk about that in terms of how rents are faring there.
Yeah.
So, I'm going to hesitate a little bit as far as saying that you're going to see above average appreciation and whatnot. If I was operating in a vacuum right now and I saw 1.5 months of inventory, that would lead me to believe that. But you know what? I'm going to leave a little bit of space to really see how the chips fall. And it doesn't really matter if home values go up 10% or 5% or 3% next year, or they stay flat. Because if you're investing like me, like I recommend, you should invest for a full market cycle. And no matter, even if you get 12% appreciation next year, like we did this past year, I'm pretty sure that over a 20-year cycle, you're going to wind up right about 4.3% per year on average. So it honestly doesn't even matter to me.
Okay. All right. There you go. Conservative Gregg Cohen, the turtle. I want to put a button on this thing because we pride ourselves here on clarity, transparency, everything. Anonymous attendee, I'm assuming it's the same anonymous attendee, followed up saying that the townhome that they were talking about is 7876 Play School Lane, and that it is in fact JWB inventory. You know anything about that property?
I know we have a number of assets on Play School Lane. I don't know the specifics on the pricing in the past though, but I'd be happy to get that information for you, either my team or myself. It doesn't sound like, I'm not sure if you're a current client yet, but if you have a contact at JWB, probably been speaking with one of the mics on our team, reach out to them. We are completely transparent and be happy to give you that information.
Yeah, so she says that the team said that it is a reflection of the Great Recession and took 15 years to recover, but still zero appreciation. I don't know. Maybe you can go live about it in the group later or something like that. Cool.
Yeah, absolutely. I mean, there's certainly a chance that JWB bought that property in the past, because we bought a lot of properties coming out of the Great Recession and then held on to it for a long period of time. So maybe there's something there.
Got it. And at the end of the day, you're talking about this home appreciation number as one macro trend. Is there a space that there is one property that is worth the same thing that it was worth in 2005?
Oh, definitely. I mean, you really don't know you want to make decisions basically on the macro trend when you're thinking about investing. I mean, everything I do is really on the macro trend, especially for the timeline and, the buy and hold timeline, which you guys probably get tired of me talking about, but I think that is the best way to make the best risk adjusted return, right? Follow a model that consistently works. You don't have to be an expert. You just have to work with a team that understands this, can make this an enjoyable process, and then hold on. But to your point, there will certainly be other properties that don't fit the exact mold. There are some properties that are purchased at this price in this market right now that sell at this price, right? Now, there may be extenuating circumstances for this individual that they needed to sell quickly, or maybe they were facing foreclosure, or maybe there was something else going on in their life that selling for this price is the right thing for them. So you're going to find a ton of those examples out there for sure. But what I'm quoting you, and the reason that we basically look at the median home sales price across an entire market is because that takes those one-off anomalies out of the equation. The median actually is the reason why you take the median rather than an average, because the median, is the form of the average that is the middle point of the sale, and that's why you reflect that in your when evaluating markets and evaluating appreciation rates.
Yeah, that makes a lot of sense. The median is not affected by a major outlier bringing down a whole average. It's the median. Got it. All right, man. Let's get into rent collections. So, another anonymous attendee had the first question of the day, which was, how is COVID impacting rent collections now and in the future? I think it's time to get into that.
Yeah, absolutely. And so, I was really confident as far as housing prices not going down, although I was a little bit skittish about going live on social and all that good stuff. It's a little bit skittish when you're the only person out there saying it. But I really believe that housing prices were not going to go down. When it came to rents, I was also really confident that compared to other asset classes, that this housing asset class was going to perform better. Now, part of that was because I looked at other asset classes around, seeing an incredible amount of variability. I mean, the stock market lost 26% of its value in 4 trading days. Of course, it has since recovered, but just that up and down with investors' wealth being really hung in the balance, I saw a real challenge there. I saw bond yields going way down. So I felt really confident that our asset class, especially over time, was going to be a better decision of where to put your money. So that was the case. But at the same time, I was realistic, and I didn't know exactly how the stimulus packages would come. And I think that was a big impact on how we were going to be able to collect rents in a COVID world. And so what I prepared clients is I said, I would expect a short-term temporary loss of rental income. As it has turned out, that was a very conservative approach for me, which is kind of goes along with who I am.
On brand.
And rents have been incredibly strong, well beyond the expectations of myself, my business partners, and really other movers and shakers in the single family rental investing space. There hasn't been an asset class that has benefited more and remained more consistent than single family rents, specifically in a market like Jacksonville in the Southeast, where people are migrating to. So it's great that you pulled this stat up here, Pablo. We're kind of looking at rent collection numbers. And what I wanted to do is to show not just the overall yearly rent collection percentage. I wanted to show sort of a baseline of where we were in 2019 prior to COVID. And then now, since we've been dealing with COVID for 9 months now, show really where we are in 2020 to try to zero in on what the COVID effect has been for JWB. And as you can see, quarter over quarter, we're slightly below where we were in 2019. But not all that much, right? In quarter one, we were the closest, right? In quarter one of 2019, we collected 99% of rents. In quarter one of 2020, it was 98.6%. So you'd say, well, the vast majority of that was prior to COVID, and that makes sense. In the heart of the COVID time, when there was a lot of unknowns and the stimulus still wasn't passed, that was Q2. And our rent collection in 2019 was 99%. If you look to 2020, it dropped, but not all that much. It dropped to 97.8% for Q2. And it has continued to get closer to what our normal percentages are in Q3. So overall for the year, the COVID effect to JWB rent collection is less than 1% off, which I think is really incredible. Again, comparing this consistency to other asset classes, just nothing compares.
Yeah, that makes a lot of sense, man. And I knew, we've been talking about it all year, right? So we know that it's been performing well. It's an incredible, it's real testament to the team of what they've been able to do on a portfolio level. But as we were preparing for this call, I was like, Gregg, I think you got to personalize this, right? Like at the end of the day, Anonymous doesn't care about, your portfolio. He she cares about their house, right? So we wanted to bring this down more into a micro level. Let's talk about that. Talk to me.
Yeah,
Aim
and
a little smaller.
yeah, let's do that. And let's get to these slides in a second here,
Okay.
because I don't want people to get distracted. We'll share all that information in just a second here. We've got more than enough data to back it up. But the reality is that while rent collection rates are high, much better than expected, and a small fraction below where we were last year, that doesn't mean that certain clients aren't hurting, right? We manage 3,600 homes. And so even if you're talking about a small fraction of rent collection being lower, that translates into tens of thousands of dollars that really affects our clients. And so I want to make sure that people understand that this isn't perfect, right? Our standard, our expectation for COVID was to make the best out of a completely unique scenario. And there are clients that have been negatively affected by COVID, right? They do have some residents. There are some residents, so we're going to show some of the information here, that haven't paid rent since COVID broke. I mean, that's just reality. And you would know that I wasn't being genuine if I said anything other than that, knowing that we manage 3,600 homes. But I think what you're going to see with the data, and what we are really trying to do, is to make the best situation for a client and a resident. And there's a lot that we can do to set up a better situation than most, even in this environment. So a lot of things that we can do to take a scenario where somebody's not paying rent and there's a foreclosure, an eviction moratorium, which there is at the moment, and still work to find common ground to get that person to get onto a payment plan, right? And so this is the reality for a very small fraction of our clientele. It's just real. It's certainly not going to be perfect. That wasn't the expectation. I want to be sensitive to know that those people, that is a struggle, right? For those people, as far as rent collection this year, it's a down year, right? Now, at the same time, when you came on with JWB, we expected that we were going to have down years every once in a while. And the other years, non-COVID year for this, will balance this out. And I have no concern over their long-term performance, but I just wanted to make sure that people knew that it's not all roses. And I want to be sensitive to those folks who are hurting right now.
Yeah, that makes sense. And Miguel Angel Sanudo, who joins us here on a weekly basis, he is one of those cases, right? He says 2 of his houses has had no rent collection. So, he's struggling. Miguel Angel, like, hopefully maybe you can put in the chat how prepared you were for this. Like, did you have the reserves, anything like that? We'd love to shed some light on that experience. But Greg, you said that there's a couple different ways to mitigate the pain for the renter, for the investor.
Let's go to the graph where we're showing the real numbers of how many people, let's call, are hurting, right? So out of all of the percentage of homes that we manage, how many are struggling at the moment? And when I say struggling, I would mean enduring an eviction at this time, or something that's called a stipulation agreement, which we'll get into in just a second as well. But when I ran the numbers, I wanted to do something to give more people just an understanding of really where it is as far as numbers and the not so rosy details, right? I looked at the number of homes that we have under management that have active leases on them, and I wanted to see how many are not current on their payments at the moment. 97.2% of all of our residents are current at this time. There's 1.2% of the portfolio that is in an eviction at this time. Now, everybody who's not current has already been started with filing an eviction. So there's nothing in between there. So you've got 1.2 that have an eviction filed. And then you have another 1.6% out of the portfolio that had an eviction filed. But just like you were talking about, Pablo, an additional step that JWB does to make this the best situation we can is we entered into what's called a stipulation agreement. Stipulation agreement is basically a payment plan that is sanctioned by the court. And so what happens here is the eviction is actually filed, but we're working with that resident and with the court to set up a payment plan. And as long as the resident takes care of that payment plan on the agreed upon amount of time, then the eviction is halted, which is great. That's what we want. We want that resident to continue that payment plan, to pay everything back, including any fees that were incurred by the owner. And we want them to get back to a great place. So you can see here that 1.6% of our portfolio is in a stipulation agreement. All in all, the real numbers on this comes out to about 95 residents that are either in an eviction or a stipulation agreement. There's 41 that are in an eviction, 54 that are in a stipulation agreement. And we look very positively on stipulation agreements. That's a good sign. And out of roughly 3,466 active leases, that's kind of where we're at. A very small section of the pie has payment challenges at this moment.
Okay, so that's the full pie. There's two buckets, there's three slices of that pie, right? Like there's the slice that hasn't been cut out, right? Like the pie. And then then there's two pane slices, right? So like, let's dive into the pane slices.
Yeah.
All right. So let's do it.
So this is great. So I'm really trying to see those clients, how many clients are really having a dramatic impact and loss of rental income that isn't easily overcome, let's say, over the course of another year of great payments and all that good stuff. The way we look at that is if there's $3,000 that's owed because of the payment plan, really, or if there was an eviction that is many months old, right? That $3,000 number internally is kind of what we look at. What we're seeing here with the stipulation agreements, again, the payment plans, is out of those 54 people that are on those payment plans that some have been on since COVID broke, 48 of those are what we call lower dollar value plans. They owe $3,000 or less on their payment plan. And again, that includes rent as well as any eviction fees that they incurred to do that. So you're talking about, generally speaking, 2 months of rent, maybe plus some fees, is what people have been behind. And that's 48 out of the 54 total payment plans or stipulations. So when I saw that number, that tells me that people are in really good striking distance of recovering from the short-term temporary loss of rental income, which is what we started out saying.
Great. Okay. So that gives me a good understanding overall. We have a ton of questions that I just want to dive into, right? I know that we were going to kind of play with predictions in the future, but let's answer some questions, right? And again, I'm happy Miguel Angel is in the chat to shed some light onto like what his experience is on that small piece of the population. Thank you, Miguel Angel, for sharing anything that you can, so everybody sees both sides of the equation. Chad Willis asks, since COVID-19, are you seeing demand move toward 4-bedroom homes more than 3-bedroom homes, or is it staying the same?
That's a great question. No, we haven't seen anything noticeable as far as where demand is moving as far as renting homes. Homes that are 3-bedroom homes or 4-bedroom homes are still renting really at the same pace. So we haven't seen that.
Okay. Mike Foster has a question here. Greg, during the past several months, you've mentioned several times one of the compelling reasons to invest in JWB properties now is because of very low interest rates, but those rates won't last forever. So can you discuss a bit about how JWB is also positioned to be successful for its clients in any real estate market? For example, return of high mortgage interest rates, increase in percentage of home buyers versus lessening of home renters, or whatever the circumstances.
Yeah, absolutely. I mean, we spend a lot of time preparing for what comes next because we make the decision to stay here in Jacksonville. We want to have a huge impact here and we feel like it limits our risk for clients. So if we're going to do that, that means that we're not going to be able to do what other turnkey providers do, which is go to a lot of other markets out there in search of inventory. And we know that, we enjoy that decision, and we section a big part of our business to think about what is coming next. Right? Because Mike, as you're talking about, interest rates are incredibly low right now. And we just looked at the months of inventory, which would lead to, in a vacuum, if we're looking at it, would lead to higher than normal home price appreciation. So Pablo, give me a little help here. When interest rates go up and home prices go up, what does that do to positive cash flow?
It's gonna hurt cash flow.
Right. If you don't have other assets, if you're buying assets in a year from now, if like a company like JWB has to buy the asset in a year from now and then turn that into a positive cash flow investment and put the build cost into it, or the renovation cost into it, it's going to get really, really hard for inventory providers like JWB to do that if they're just starting from scratch a year from now, buying inventory that they have to sell, a year from now. We operate very differently so that we have a runway for clients. And a big part of our strategy started back in 2011 when we started to buy more lot inventory than we were going to sell. And we have done that for many, many years now, right? I remember years where we were buying 700, 750 pieces of land or properties and only selling 300 or 350. And the purpose of doing that was to make sure that in this environment, as prices rise, we saw this happening, we saw this shortage happening, that we would already have our land acquisition costs set, right? And then we also, of course, have great relationships with our builders. So we're able to keep those prices more in line. We're not as susceptible as others would be out there, although building costs do rise. And so what we're able to do is to continue to sell cash flow positive rental properties a lot longer than well, I won't say always and never. I don't like to say everything, but I can guarantee you that we're in a better position here in Jacksonville to be able to provide cash flow than a lot of other turnkey providers out there. My prediction there is that you're going to see a lot of turnkey providers go out of business in the next couple of years. Simply, they have the demand from people. They're going to love this asset class. They simply cannot find the inventory because acquisition costs, reno cost, and build costs for them will be too high because prices will be rising. So we do a lot. We plan a lot for that. At the same time, my team, they are just, I don't know what the right word is. They are warriors when it comes to figuring out ways to lower maintenance costs, vacancy costs, ways that we can provide value. We've got a couple of things that maybe as we get close to the beginning of next year and probably into next year on the show, I'll reveal a couple of the things that I know that we're doing that are going to drop maintenance costs. So I'm really excited about those. We're constantly challenging ourselves to do that. And then we're also thinking about what's coming next, right? You guys have seen us lay out shipping containers as an investment that we did with our own money in downtown Jacksonville. It's never been done before. We didn't know how that was going to work out. Quite honestly, from a numbers perspective, it hasn't worked out exactly the way that we wanted because we learned a lot the first time. But the reason that we do something like that is not because I think that we're going to sell shipping containers for turnkey rental property investments. That's not what I think at this moment, but it could be, right? We have to try these new things. We have to be on the front line of innovation when it comes to real estate investments here in Jacksonville. And so we're doing that years and years in advance so that by the time that there would be an issue, we've got multiple avenues to provide positive cash flow for all of you out there.
There you go, man. Great answer. I love the idea that you are here to stay and your actions, name it, right? Like your actions show it. Like I've made no bones about the idea, right? Like I think not everybody knows that I don't work for JWB, right? Like I'm a service provider, I'm a part of the marketing team. But seeing you guys operate as a business model, everything from like the business planning and how, core it is to your operation and ingrained in your operation, the idea that your cash flow for the next 3 years, no matter what happens, the fact that you make your providers do the same thing, right? Which ups the game. And then the idea that you have your own R&D department that's out there testing and like iterating on you have one guy who's a partner whose job is what is JWB in 20 years. I think that's phenomenal, right? Like, so I just think that's really cool. And anytime you talk about it, I feel like I got to say something. So,
Get a little bit clamped.
I get a little bit clamped. All right, let's keep going. Chad Willis says, actually, you kind of answered this. Chad Willis says, I've heard that the cost of lumber is dramatically increased. Has JWB pivoted to other building materials to keep costs down?
No, we haven't pivoted from lumber. That's still a core part of how we build. We're keeping a pulse on it and doing what we can to make sure that cost stays in line there.
Okay. Raja Bontu says, what is the current DOM for single family versus condo / townhouses? And I want to add to that, asking for a friend, what does DOM mean?
DOM stands for days on market. I would assume he means for home sales. I don't have that breakdown for you, Raja, but I was just looking at our days on market overall, and it was somewhere around 32, 34. That's the number of days that it takes to go under contract for sale in a marketplace. And that's down from what it was a year ago. And that would be reflective again of a low supply marketplace where things are selling quicker because there's less of it and home prices are higher. People are paying more and they're making decisions quicker, and properties are lasting less days on the market.
There you go. Anonymous attendee asks, by law, what relief do current tenants have from COVID, and how is that impacting current landlords/investors for JWB Homes?
Yeah, that's a great question here. So this is always a moving target. So, when you're listening to this podcast or tuning in later on the group, the information may be slightly changed, as I hopefully you all can be sensitive to that. But as we stand right now, a lot has changed since the last time we talked. So originally there was a foreclosure moratorium and an eviction moratorium, which meant that you just simply could not start to file an eviction. And depending on the type of loan that you had, you couldn't evict. Where we are today is there still is a national eviction and foreclosure moratorium. However, you are able to start the eviction process. And an interesting and important thing that has changed is now it's the responsibility of the resident to show that they have been negatively affected by COVID, both from a financial perspective, and then there's 5 points that they have to attest to. One would be that they don't earn over a certain amount of income. Another would be, what their next living situation would be. So you're putting the responsibility on the resident to prove that or to attest to that. And so you can start the evictions. We do start all evictions that need to be started, of course, after treating the residents with compassion, right? We're going to work with them as much as possible, but our job is to start the evictions when it's necessary. So all of those have been started. And then it goes in front of a judge. And it's still a little bit up in the air to see how far evictions are, how successful they are. Can't really give you good information other than to tell you that there have been some that have gone all the way through. There's a large portion that have not. It really is yet to be determined as to how successful those are, but you can actually evict now, assuming that a resident does not meet those attestations and does not do that. And so we're seeing that come through in a small number at the moment.
Interesting. Okay. I'm going to take a little pause right here because we're 5 minutes away from the hour. Greg, do you have extra time today? Can we go long here? Because we got another 10 questions that I want to get through.
Absolutely.
Cool. I also want to say that because we're coming up on an hour, Greg just mentioned the Facebook group. Tonight in the evening, Greg hosts a watch party inside the Facebook group where we rewatch the episode together. He's there answering questions that you can chat with him and talking it up with Greg. So if you're not part of the Facebook group, number one, I suggest you join because it's awesome. We have close to 1,900 people in there. It's our cool club. Used to call it the secret cool club. Now it's just a cool club because there's too many people to call it a secret. But we get a lot of engagement in there. Like I said, almost 1,900 real estate investors and knowledgeable people that are a resource, not just Greg and not just me or whatever, right? So, draw on the power of that. To get to the Facebook group, go to jwbfacebookgroup.com. It's not that hard. Apply to get in. You'll get in no problem and join us for the live tonight, right? So I just want to kind of encourage everybody. I'm going to put that link in the chat right now, but in case you got to go because it's been an hour, we're here. Ready, bud?
And if I can take a little bit of time and maybe ask for a little bit of help here, we're really close to accomplishing one of our goals with the Facebook group. Early on, we said that we wanted to get to 2,000 members in the group by the end of this year, and we're at about 1,900 right now. So if you are a part of the group or you're thinking about it and you know friends or family or anybody in your email list or on your social media that you think would really get a lot of value out of the show and in the group, it would really be awesome if you would send that along to them. You can send that link to them, which is jwbfacebookgroup.com, and it'd be cool to grow the community with like-minded folks. So thank you guys in advance.
True story. Also, FYI, you're able to just invite friends straight into that group, right? Like I think as a member, you can go, there's a part that says invite people and you can just go straight into Facebook, no friction. So yeah, that would be awesome. If everybody here like invites 4 or 5 friends that they want to be rich when they're older, that'd be great. So, all right. Rick Margwin asks, will your inventory of home price rise with constant appreciation in the market for investors? Currently, it looks like around 135,000 to 230,000. I could see the low end be around 180,000 in 5 to 10 years, especially if supply is low.
Yeah, I'm probably going to hesitate before kind of saying where I think prices will be as far as turnkey inventory in 5 to 10 years. But just generally speaking, yeah, the way this model needs to work for a turnkey provider is they need to be able to sell the property at market value for it to work, right? So our homes are priced at market value, which means that the sales price is based on the comparable sales of other properties around there, and justified by a third party appraisal and all that good stuff. So the model really isn't going to change based on home price appreciation, right? It's up to turnkey providers like JWB to come up with creative ways or to prepare in advance to make sure that the inventory that they have can still be cash flow positive, and it's going to sell at market value. So yeah, as home prices go up, you're going to see turnkey providers' home prices go up because there's just no other way that the model will work.
That makes sense. Miguel Angel Sanudo asks, what kind of guarantee offers does JWB? All right, I'm going to go start again. Miguel Angel Sanudo asks, what kind of guarantee does JWB offer for renovated homes? How long should be expected to have a house free of issues for a renovated home? And will JWB pay for anything that comes up right after purchasing?
Really great questions there. So I'll try to take each one of those. Guarantees, we'll just kind of adjust, we'll take that one first. There's no guarantees. There's really no guarantees in probably most reputable investments that you make as well. A lot of times guarantees are thrown out there, and it's usually not by a provider that can just flat out perform over the long haul. It's been my experience. And sometimes people hide behind guarantees, or they get false confidence in guarantees. But in rental property investing, more than anything, right? Even if somebody's guaranteeing you that your resident's going to be placed within 10 days or something like that, for this to be successful for you, you need to invest for 10 to 20 years with that person, right? So don't get so swept up in a guarantee as being the sole reason to invest. Would it be nice if you can have a guarantee? Always, but I'm just saying, don't always rely on that as being a huge decision-making criteria, because in rental property investing, there's many ways you can lose and get a nice guarantee. As far as JWB, well, now we do have warranties. Now warranties are different, right? So for both renovated homes and new construction homes, we have warranties. This is provided for every property that we sell. There's a warranty sheet that outlines it. Generally speaking, a lot of things are going to be a year from the time either the renovation work was done, or that that it would be installed if it was a new construction home. There's some slight variations there, but it's nice to have that peace of mind. So that's provided with every renovation or new construction home with JWB. And then I think you said, how long could you expect before you have issues? You're investing with us to make sure that this is consistent cash flow for you. You're investing with us because we have long-term leases in place when you become a client of ours. And you're investing with us in the quality of the renovation that my team does, right? Everything you're doing is investing with us because of our team and the ability to provide something that doesn't have issues. Now, that doesn't mean that there's never going to be an issue 3 months, 6 months, 9 months into the investment, right? I want to prepare you that I own a lot of rental properties, and there's not, and quite honestly, rental properties can be messy in the background, right? You got families living in your house, right? One of the things that you're going to be on the hook for are things that your residents do that fall under normal wear and tear. You can't take that away. You can't keep the security deposit for what would be called normal wear and tear. And so if some of those things break, that's going to be your responsibility. Spend a lot of time working with clients before they come on board and on our monthly calls, making sure that people know that we plan ahead for this. This is a part of your expected maintenance costs that's included into your expected return on investment. So there's a lot of work that's done there, and we try to make sure that everybody understands that this is not perfect. It can happen, but generally speaking, it should be lower, especially in the beginning, because of all of these things we've done to mitigate that risk.
Got it. Miguel says that he's had a month after purchasing, he's had some issues with a job that just finished for renovation. Miguel, I would love to tell us more about that so we can clarify some more. Is that something that you see happen often, Greg? Like, could that be like a contractor issue? Like what? Can you talk through something like that?
No, I'd love to get more information on it too. And I know Miguel's a current client and would love to open up the communication. I know Miguel posted in the group as well and
Mhm,
wanted some information on owner statements and some clarity, thought that they were
mhm,
a little bit hard to read in certain places. That's pretty normal, actually. We got to make sure we connect the dots between Miguel and his portfolio manager,
mhm.
get those folks talking because, sometimes some of these kind of misconceptions or things that maybe are a little bit frustrating for Miguel, a lot of those things can be solved through that effective communication. And I'm wondering if, because I know Miguel is from Spain,
Yeah.
because he's been on the show a lot and has let us know he's from Spain. I'm wondering if maybe just because of time zones, hasn't been able to connect with the team. But I would first go there, and I would imagine that be able to get him in a really good spot.
Okay, sounds good. So Leo from California has a comment here. I think it's a question. I haven't read all the way through it because it's like a paragraph, but here we go. Housing market index is at 90, as Greg mentioned in the past show. A lot of this so-called experts predicted market crash in 2020, in parentheses, oops to most of them, then predicting housing market will crash next year and will recover slowly. Where are they getting their data? I've been researching online and I can't find data to support their claim. Yes, a lot of foreclosure and unemployment next year, but people losing their homes will need to rent somehow. Am I correct? The reason is that I'm being discouraged by a few friends not to invest in real estate right now. I'm working with JWB and getting my first rental income property, weekly call with Chad Lewin, and I'm full steam ahead. But I'm curious with these experts' claim, including some of my friends whom I listened to 2 years ago, I will not be able to get my rental property in Las Vegas.
Leo, good to hear from you, my friend. Leo's always on the watch party as well. So I'm
Yeah.
excited to hang out with you again, Leo, after, tonight at 9 o'clock Eastern in the watch party. You bring up a lot of really good points. If you look at the data, um, the biggest indicator for a housing crash to me would be supply and demand, which is months of inventory. That would be the biggest one. I find very few people who quote months of inventory saying that they're expecting a housing crash in 2021, right? Because you just don't see that. I mean, it's not always as much of a shortage as it is in Jacksonville across the marketplace or across the United States, but there's a shortage almost everywhere. What is causing people to think that there may be a crash? A lot of that it has to do with, people understanding that there really are two economies right now. There's this economy that has been supported by the stimulus package. And it's also, as far as keeping people in their homes, a lot of that's been supported by the foreclosure and the eviction moratorium. And so they feel that we don't really know how bad it is until those things are taken away. And we really, as an economy, have to stand on our own 2 feet again, which there is a lot of truth to that as well. The thing about it, though, is what I would do and what I have done is really start to play some of these scenarios out using the metric of months of inventory, right? So if you think that unemployment is going to be so high that it is going to cut home sales in half going forward next year, and you know that you just can't automatically solve and double inventory, right? So maybe you say inventory rises some, right? And then you cut the home sales in half. What does that get to as far as months of inventory for you? This is kind of what I do. And then I look at that and I play those scenarios. What's a worst case scenario, right? Maybe inventory goes up by 20% and maybe home sales drop by, I don't know, 20%. I don't know. Maybe it's 50% and 50%. You come up with it and then use that as really being an indicator for where you see home prices going. If you do that, it's hard to come up with a scenario where you see home prices dropping because you just don't get MOIs that far above 7, and you need them above 7 most of the time to see a housing price decrease. So the other thing that I would share with you, Leo, is kind of go away from the short-term pricing either being a justification for investing in rental properties or a reason to not, right? Because if you can, and if you're interested in trying to share this with your friends, if they're open to listen, the reason why I love rental properties is because I don't have to know what happens in short-term pricing, right? As long as I'm buying and holding for a full market cycle, which is known to be between 10 to 20 years, most of the time, and history supports this, that you're going to see long-term average annual appreciation rate of 4.3% per year or something close to it. And if your rental rates produce positive cash flow today, real estate is a hedge against inflation, which means that rental rates usually go up with inflation in the future. So that means that you can count on positive cash flow under most circumstances. The only circumstance that I wouldn't say you can is if the jobs leave your market. So pay attention to the economy of your market. But if you got positive cash flow today, you would expect more positive cash flow in the future. And you're in for a full market cycle. It's almost like you have the answers to the test ahead of time, right? You don't have to get into the debate of what's going to happen next year because, listen, I started investing in 2006 and 2007, and the very next year, housing prices dropped like 30%. And I've still come out smelling like roses. It's because I had that long-term viewpoint. And just like we saw, real estate values do what they normally do. They return to the norm. So I would go away from the short-term pricing discussion as a justification either way, because you're going to find very, very much polar opposites if you really try to engage in that.
That makes perfect sense, man. Brad Sriro, who I believe put a home under contract recently. Brad asks, what are your thoughts about the saying regarding investments to be fearful when others are greedy and greedy when others are fearful, specifically as it relates to real estate investing?
Yeah, I think there's a lot of truth to that. That's Warren Buffett, I believe, or at least it's one of those quotes that everybody attributes to Warren Buffett. I think really what comes to my mind is, many people invest on emotions and they just don't know where to look to find data that would give them an indication of where things are going. Now, that doesn't mean that the data is always going to be right or tell you where it's going, but what it does is it gives you clarity to make your decision. And so a lot of times, especially in an environment like this, the data is going to show something that a lot of people may not agree with, or, and that would lead to you doing things that, quote unquote, would be taking action when others are fearful, right? Greedy is, I don't believe in being greedy, but I know what the intent of that term is, right? Taking action when others are fearful, right? So if you've got really sound methodologies for making decisions, especially if you're working with a team like my team who has lived through this many, many times, you're going to be really confident in the decisions that you make. You're going to tend to listen to a lot of the talking heads, or you're going to tend to listen less to a lot of the talking heads. You're going to go rely on the data and the people that have lived it. So I think there's a lot to be said for that. I wouldn't specifically invest because others are not, but I think a lot of times data leads you to do that. All
right. Now we got Lee Bishop, who, I would say if I were to give somebody the MVP of being a fan of this show, I'd give it to Lee Bishop.
Lee gets it.
Lee gets it. Lee Bishop gets asking. Yeah, what do you say?
Well, I was going to say, and for the MVP, we got to step up our game as far as the show going forward, because as the MVP, Lee was given a T-shirt, but he had to wait like 4 months to get the T-shirt. So I guess that's the bar that we've set for the MVP of the show so far. I think me and you got to raise that bar a little bit.
So it's funny, man. I've literally been the last 2 days kind of in the shower thinking about, man, I should buy a whole bunch of like Not Your Average Investor Show swag and send it to people.
I was thinking the same thing too. We'll make that happen, man. We'll build a system for that for sure.
Yeah, totally. All right. So Lee Bishop asks, Gregg, what is the policy of JWB in regards to leasing clients that may be consistently delinquent in rent collection?
So, this policy has had to change a lot during COVID, that we had to come up with completely new policies, because our normal policy non-COVID time is that if somebody is not paid, then we're going to try to work as much as we can with them. But if they're not paid very soon after the first of the month, we're going to file the eviction, assuming that there's no communication from them. If there's some communication and we can work on something, we may give them slightly more leeway if we determine that it's the best interest for you as a client. But there's not a whole lot of leeway. So in a normal world, we're filing an eviction soon after the first of the month if they haven't paid rent and there has been no communication. During COVID, we weren't able to do that. Now we can. So that's why I was saying we have 41 evictions in process right now. There's no other people that are late on their payments that evictions haven't been processed or started. I'm sorry. So we're back to normal times as far as filing evictions.
Okay. Jackie Hung has a question. Which areas or zip codes do you have more evictions and or less rent collected? Do you have any kind of like data on that?
I don't have that data, Jackie. I I don't have that data. I would imagine there's not very many differences between zip codes or evictions or rent collection. So I don't think it really matters.
Okay, sounds good, man. This just in, Greg doesn't know everything. All right, here we go. Anonymous attendee asks, you know what? I like this question, Anonymous. I've been asking you this too, right? When getting new renters, is there anything that can or is being done out of the normal to help avoid the COVID loss of rent? How long is the moratorium right now? You kind of answered the moratorium piece, but yeah, is there a pivot? And I think, Greg, maybe you can talk about the idea of a renter today versus a renter that signed their lease in February.
Yeah, we've talked about this a couple of times, but I think it really matters, right? If we're talking about your most risky time to make an investment in a rental property, would have to be February of 2020, because that was before we all knew, really the whole entire United States knew the burden of COVID and how it would affect our daily lives, right? So if you think about that, at that time, we were qualifying our residents stringently like we always do, but we didn't know that bars and restaurants would be shut down and gyms would be shut down. And a lot of the service industry jobs would be shut down from, call it March, April, May, all of that good stuff. So, if you're thinking about it from that perspective, really the riskiest time to make the decision to invest in rental properties, we didn't know it at that point, but would have been in February. And the cool thing is, as we looked in February, we looked in Q1, Q2, we looked at the rent collection numbers there. Even though that was the riskiest time, we still had incredibly strong rent collection numbers, 97%, 98% rent collection, even getting close to 99% through Q1. So it's good to know that that was the riskiest time. If you look today and you make your decision to invest in rental properties and you're looking at specifically the ability for the resident to pay rent, a lot is known now about how the economy works under COVID, or a lot more is known now, right? The jobs that have unfortunately been lost, right? Some businesses have come back, some haven't. But as far as qualifying a resident, it's much harder to qualify a resident today, knowing that there's higher unemployment today than there was in February of last year. So you could definitely make the argument that it's less risky from a resident perspective today. Do we qualify them different today than we did in the past? No, right? We follow the same standards of qualifying residents based on what we know now. However, there's just a lot more residents that won't qualify today because there's 5% unemployment roughly in Jacksonville, whereas there was probably 3% unemployment. And you don't quote me on that. It was a lot lower. I don't know what it was in February, right? Something along those lines. So just giving you something to illustrate the point there. And one other thing that I will mention there, a lot of times I want people to know that eviction really is just another step in the process of hopefully having a great resident stay with you for a long time and pay rent. That's really how we look at it, as many other property management companies don't look at it that way. We've talked a lot about stipulation agreements and how that can really be a positive thing for you. And so we spend a lot of time there. There's also something that has just recently been opened up, and I shared this in the group probably about a week ago or so. It's a new eviction relief program, and this is done through Duval County. Mm-hmm. And so some of the funds that were appropriated to Duval County through the CARES Act are now being used as an eviction and foreclosure relief fund. And so residents who qualify can now qualify for up to $5,000 of relief that then can be paid to the landlord to make sure that they do not get evicted. And so we've spent the time working with the government agencies to make sure that we can make this smooth and simple for residents. We handle all this for clients. You guys never have to know about it or never have to lift a finger. We do all this for you. And what we found is that we've been able to bring this relief. The city has been able to bring this relief. We facilitated it for residents on a few occasions. So these are other things that we're doing now. I also want to temper expectations to let you know that there's an incredible amount of hoops to jump through, and it is not applicable for all residents. So I don't think that this is going to be a save all experience for everybody. It's just something additional that we can do to help. And when it works, it's great. But there's a lot of other things. We work with local charities who can provide short-term resident relief for rent payments, even in non-COVID times. We're really, really trying hard to, find all of those sources of rent for the residents, because we want them to stay for a long time and we want clients to be taken care of. So
There you go. Greg, we're at 148. I unfortunately do have a hard stop myself today. So like I gotta be like I'm getting interviewed on a podcast at 2, so I gotta get off probably about like 1:55 if that's okay.
that's good. And I was playing chicken with you. I was going to see who was going to say it first.
Who's gonna say? All right, so let's crank through, man. We got 7 more questions. So you got 1 minute per question.
Okay.
Roger Evans asks, has JWB considered building new homes with block instead of lumber/wood? If so, is there a big difference in cost since lumber has increased so much?
Yes, there would be a huge increase in cost. The financials on the situation just wouldn't work out well. We couldn't produce it at scale to provide positive cash flow and still to be able to offer them at market value for you. So it's something that we have looked at, but the reality is in Jacksonville, especially with building codes the way they are, would be highly unusual to build concrete block homes in our neighborhoods, our below middle income neighborhoods.
Cool. Margaret Smith, actually, I'm bringing this to the front because it's relevant to your last thing. She says, I'm surprised you don't say charge extra security or 2 months plus last up front. But I guess that plays into the idea that you're trying to create a long-term relationship, but that's not good for the tenant, or why is that?
It just comes down, there's a million factors when you're thinking about how to produce the best return on investment for clients, right? We need to keep days on market very low from a renting perspective. We need to keep that ability to fill the home very quickly. And, we're also looking at really what the marketplace is, generally seeing, where does our offer stand and what other residents can pay to a competing house. And then we're also looking for the best long-term return on investment. So what levers can we pull? So it's certainly something that we've looked into, Margaret. It's something that, in a perfect world, it would be able to be done. But what we made the decision to do is that long-term leases is a better lever to pull at this moment because, and then of course, long-term leases with rent escalations in them is a better long-term fit to produce a return on investment for you. But we're always looking to it. It's just not something that's done normally here in this marketplace. And I think if we did that at the current moment right now, we might run into a situation where other really important metrics to you might not be as rosy, like keeping your home rented very, very quickly, getting that home turned very quickly and rented on the turn very quickly. And most importantly, the average length of stay for your resident, right? We need them to stay a very long time, and long-term leases are the best way to do that.
All right. Miguel Angel Sanudo asks, how does JWB set the price for a property?
That's very simple. We set the price of the property based on comparable sales in the neighborhood. And this is very normal. So when you get a loan to buy the property, the bank actually requires that there's an appraisal on the property, and they hire a third-party appraiser. JWB has no direct connection with the appraiser. That's ordered by the bank. And then that appraiser goes and looks at other properties that have recently sold in the neighborhood to make sure that the sales contract price matches what the appraisal price is. So that's how we set the price.
All right. Mike Foster asks, ballpark, what are eviction costs for JWB clients who need to go down that road?
It costs about $500 to hire an attorney to handle the eviction. And JWB makes this a very smooth process for the owner. All you will really know or have an impact on is really you'll have an additional $500 expense to start the eviction. But as I mentioned, through stipulation agreements, that $500, if the resident continues with that payment plan through the stipulation agreement, that is also included there. So you get paid back, which is another reason why we do love stipulation agreements, because it's a great way to get you back to square one with your resident.
All right. Margaret Smith has a follow-up on the last one. Same question about rentals. How do you determine the rent amount? Is that ever negotiable with potential tenants?
Typically, it's not negotiable. I mean, the way that we do it with residents, as far as setting the rent amounts, is because of our consistent approach to being in the same neighborhoods. So we have purchased over 3,000 homes. Clients have purchased over 2,000 homes with us. We manage over 3,600 homes, and they're in 4 neighborhoods in Jacksonville. And so we just dominate these areas. And if you tune in on Thursday and you look at the property of the week with us, many times we show the map and you're able to see on the same street, there's this house, this house, this house, this, and it's so on and so forth in these neighborhoods. So whenever we need to understand what rental comps are or the price of rent that we should set, we just simply look at the properties we're managing. And we probably have more data to support rental comps than any other single family residential property manager here in Jacksonville. And we use that to the advantage for you to make sure that your rental rates are high, but also realistic.
There you go. I'm going to take that opportunity to tease the rental property of the week. Our Thursday show, if you're still with us and you haven't been before, is we break down a property of the week that is just nuts and bolts going into numbers on investments. Let's try to get through the rest of these questions here, Greg. Ready? Value, baby. Close hard. Chad Willis asks, are floors all tile or other hard surface? My thought is this may help turnover costs instead of carpet. Thoughts?
That's a great thought. So we have hard surfaces in the living areas for sure, many times throughout the house. It's not 100% necessary to have a hard surface in the bedrooms, but it's always nice to do that, especially in the living area. So not always tile. Many times it's luxury vinyl plank flooring, which is a great alternative and lowers the cost, and the replacement cost is really high. You just want to stay away from carpet in the bedrooms. And so we incur that additional cost for you to lower your long-term maintenance costs. That's how our maintenance costs stay very low.
There you go. Anonymous attendee asks, is there a rent insurance which the tenant can buy or the owner can buy?
So renter's insurance is something that your resident could purchase. We do not require it for your resident. That would be insuring their valuables in the home while they're renting.
I think this is like an insurance for missed rent is probably the question here.
Right. So no, there's not insurance for missed rent.
Okay. Last question. We're there, bro. Chad Willis asks, at current building rates, when does supply catch up with demand in terms of time, months, years? Have you done that math?
I don't know that answer.
Finishing strong.
So many variables there. You know what? This is going to be great. You're going to love this. Hype guy, Pablo. You know, you just got to tune in every week to the Not Your Average Investor show to keep a pulse on it. There you go.
There you go. Problem solved.
I think it's going to be a long time. There you go.
Awesome. That being said, this has been great. We do have to jump off here, but man, Greg, you sat there, you answered the tough ones, you answered the easy ones, you gave a lot of advice, man. I know that coming up to this, I really challenge you to like get on this data, make it useful for everybody, buddy. I got to give you a compliment of how you showed up today, man. Really, really well done.
Thanks, brother. That's why we're quite a team, brother. I appreciate your perspective. I think you speak for everybody who is listening to the call, and it just makes this show better and better. And we appreciate all of you for spending time with us, man. An hour and a half. That's pretty awesome.
Flew by,
and guess what?
Right?
You get to spend another hour and a half with me later at 9 o'clock on the watch party. So
That's right. That's right. You got an extra half hour for the watch party too. Thank you everybody for tuning in for us. We had, like over 40 people, the majority of the call. We still have 31 people here. We do not take it lightly that you spend your day in the middle of a work day with Greg and I here. Like it really, really is an honor to have this community. I hope that you join jwbfacebookgroup.com and hang out with us. I hope that if, after all this stuff, you want that free investor toolkit, go to JWB web class. I hope after all this stuff, if you want to hop on a call with somebody, go to chatwithjwb.com and be a part of this amazing, amazing community. It wouldn't happen without you. Thank you so much. Greg, I'll leave it up to you to say goodbye.
Yeah, I echo everything you said, Pablo. I'm going to keep it nice and short and sweet and appreciate all of you. Thank you for all the love and support, and already looking forward to the show on Thursday for the property of the week.
Week. See you at the watch party, everybody.
See you, everybody.